So today again we have a very interesting topic, and this is setting the right milestone. Is your journey towards 1 crore? And yes, I'm seeing comments. The meeting has started. Yes, the meeting has started. We had some delays because of some technical issue that we're facing across all our webinars today. There is a good. We've just had a platform change. I think everything has gotten updated, and with all updates coming in, it just becomes becomes a little annoying to shift to get equipped with the new update, right? So yes, the meeting has started. I won't take up a lot of time as well. It's a very short, nice, sweet presentation. So the topic is very simple. It's setting the right milestone. Now everybody has this target, and everybody on the platform has this target of 1 crore. And how do you reach that 1 crore? Yeah, everybody talks, yeah, but is it easy? Most investors think that it's very difficult for you to actually go and start saving towards that 1 crore, and it's going to take you a lot of time. So is it, how long is it going to take for you to actually go out and start reaching that 1 crore target, right? So just a little disclaimer. Milestones2Wealth is a behavior oriented program. It's not a buy and sell platform. We do, however, take those calls based on your risk profile, your health checkup, and only then make sure that is your financial health checkup, and only then actually help you and guide you towards saving your money so that you can build wealth for whatever goal you have in the future, right? So it's a behavior oriented program. It's not a buy and sell recommendation platform, right? This is a webinar and this is a topic that we have covered multiple times, right? So you will see repetitive. Building wealth is boring. uh, there will be a good amount of repetitive. So if you've already been on our webinars, if you've already seen how we are presenting, what we are talking, and how the communication is, I think you can limit yourself to Q&A, and that's where your interaction should be. But for those who are attending for the first time, yes, I can guarantee you that it's going to be very simple for you to understand. Right. So again, my favorite slide: how do market cycles work? Cycles are also uh, behavior oriented. It's all based on fear and it's all based on greed. During times of when you see during times of over pessimism, too much fear, investors will not, savers would not want to participate. But when it comes to things doing extremely well, like how things are right now, you would see a lot more people saying, yes, buy this, buy that. You will see everybody who was not in the market enter the market. And then, of course, that does lead into some sort of an over optimism, and it sort of peaks out. This thing takes place over multiple years. Shorter term cycles usually tend to be somewhere around 5 to 7 years. Longer term tend to be somewhere between 10 and 12. Right? Always this happens. So as an investor, as a saver, you must be aware of what is happening right now. If you take off the newspaper and you see there will be multiple buy recommendations. If you go on to YouTube, you will have multiple buy recommendations, what you should be doing, why you should be doing that way. So it gives you an understanding to say that yes, things are looking optimistic, and we are headed toward that place where things do look to sort of peak out. Right. That is what happens across markets, across countries, across asset classes as well. Right. So always have this sort of a long-term picture, because you might see a peak in one asset class, but you might not see a peak in the other asset class. Likewise, for everybody who's on the program would know that we are now advocating and guiding investors more towards precious metals, towards debt, towards arbitrage, because that's where the opportunity lies. To give you one example, I think this is as of yesterday. As of yesterday, arbitrage yields are somewhere around 8.5%. So it's nowhere near being shown to investors saying this is what you should be doing. But anybody who has that sort of approach, it will come on to the next slide, right? If when you have that sort of contingency, where you have money that is being parked as liquid, where you have money that is being parked, in your current account or savings account, whatever is meant for your contingency, that money you can park here because it's tax efficient as well. So there is always a use case in every cycle. There's always a use case for every asset class in every particular cycle there. This cycle is one of the best cycles that we are seeing, because opportunity has opened up in pockets for equity, which we have covered multiple times in the previous presentations. And we are seeing opportunities coming up both on the precious metal side and on debt as an asset class, right? So markets, this particular market cycle is very peculiar. You are having opportunity across the board, right? Now we'll sort of go on. How can setting a milestone actually help you, right? We have set the target 1 crore, but for you to reach that particular 1 crore, you have to start thinking from a perspective of having smaller milestones for you to reach that particular target, which means micro steps, right? First step for you is to create a savings habit. Now, what do we do in Milestones2Wealth is first we make you aware, right? It's not first day you come and say, okay, now you go and buy this. The minute you buy this, it will become much more better for you. You will reach your goal, whatever that case be. That's not the case of how we do things here at Milestones2Wealth, right? First step is always to get yourself aware, right? Think of saving every day, right? Review your savings every week. If you want, if you're very, very serious as a saver, uh, you have to become much more aware of your particular habits, where your spending goes, and what are you actually spending on, right? Once you get a fair understanding over months of how you are spending, where your expenditure actually is going overweight on, right? Automatically you would know, is this a necessity or is this not a necessity, right? Nobody is telling you to live a minimalistic life. That's very complicated. It's not practical at all. Everybody is aspirational here, right? So the first step is always be making yourself aware and create a savings habit. That's what Milestones2Wealth will do. Now, how do we do it here? Is one, we take a risk profile, and second, we do a financial health checkup. The main thing is the financial health checkup, where we take a lot of variables into consideration. Right, we see what you're currently saving and what your potential is to save actually is. So when you go to the doctor, you get a full body checkup at the hospital, and then you go to the doc. The doc says, hey, you're lacking on this particular vitamin, you're lacking on this particular thing. You still have the potential to do a lot more. You can get a lot more better, you can get a lot more fitter. So this is what you have to do. That's exactly what we do in your financial health checkup, right? We make you aware of what your savings potential is, and are you saving up to your current potential that's there, and how do we actually go out and improve that potential. Once we do this, right, once we make you aware of how you're saving, right, your savings habit, that will lead into you creating a investing habit, right? So setting a milestone is only, it starts with you, where you have to first review and create that sort of savings habit. Once you create a habit, right, you have to review your habit, right? Let's say you're getting up early every day at 6 o'clock, and suddenly there comes a period where you're losing out on that habit, or you start being overweight. Then again, there is a point where you have to go out and review it, right? So once your habit for saving is set, once you become aware, your next step is of course creating an investing habit. Now, investing habit requires you to be very, very disciplined and very, very consistent, right? That's why mutual funds are the best way for you. Direct stock approach does not help you to be consistent. Direct stock approach helps you. It only feeds into your ego, and it doesn't actually lead into you having a disciplined approach towards creating wealth, right? So setting up, the first thing that we do from a habit perspective in terms of investing is SIP. SIP is the best method for you to go out and start saving your wealth. This would take time for you. So when we say yes, target is 1 crore, how fast can we reach that 1 crore? There are some calculations at the end of this presentation, so you would know how fast you can reach it, because everybody wants things to be extremely fast now, right? Whatever surplus that you are able to get in the year, you should look to save it, right? Uh, Again, you would get multiple periods in the market where there would be opportunities that open up. For example, in June month itself, during the election time, you got a very good opportunity to invest in. Right? Investors who were able to take advantage of that particular opportunity based on how we were able to guide them. Today, they are extremely happy that they were able to capitalize on it. Now the market is at all-time high. Right. So second is always have something in your kitty, where yes, that leads up to your surplus amount for whatever volatility that can come in on top of your SIP, right? So SIP plus a lump sum is what you're looking to do, right? As you start growing your income, you must think of saving more. Saving more only means that your monthly contribution starts going up, right? These are all very small steps that you can take as a saver, that whenever possible you should look to step up your SIP every year, depending on your current financial condition. If you have other commitments, then make sure to service those commitments first, right? That's what the financial health checkup actually shows us, is that when we look at that particular potential, we see that yes, there's a lot that is going into servicing a lot of commitments. And once those commitments do get over, how fast can we make sure that this saver can actually go and fulfill their commitments? And that ultimately is your muscle when it comes to you saving into the market. That's actually what your potential really is, right? Once you're as and when you fulfill your commitments, that gives you more muscle and more power to add on to your savings kitty, right? So step up your SIP whenever possible. Now, 5 things that you need to do. Sorry. Yes, do more. Now, this is completely up to you, right? The entire thing is understanding your potential and the way you can grow your potential. For you to understand, you have to take steps by your own self to say that, see, when today is the final, right? India, South Africa. We lost a very bad, we lost the 2023 World Cup. It hurt. I don't know whether I watched the match today also or not. But the point is last time Virat Kohli was number one. Today it seems like Virat Kohli is not, but he still knows his potential, right? He understands how much of potential he has, and he knows how he should be able to grow that sort of potential. So where you're standing currently is where you stand currently on your platform is actually for you to particularly understand, right? That's why you need to take those steps. You need to be financially fit, right? Only then you can grow your potential, right? Strive to do more. Always strive to do more. Indians are considered to be very aspirational. If you see any chart, if you were on the consumption webinar, you would have seen one chart that showed Indian households. It went from a triangle to something like this, and now it's more towards the aspirational bucket. So yes, Indians are known to do more. Indians are known to strive more. They are aspirational. So these three actually come into that picture for you to become financially fit, right? Most important for you is to stay invested and maintain patience, right? This is the patience game. This is not this is like test cricket. You have to survive on the pitch, right? Whatever ball comes at you, your job is to not hit a four. Your job is to survive the day. If you survive the day in a test match, then you know that going forward you have much more confidence to take on other days and to take on bouncer balls, right? Bounce your balls. So stay invested and maintain patience. This is what you need to do. Always make yourself aware. And once you make yourself aware, start putting that money into the market, start saving more, and be consistent and show patience. That's what it means when you hear the word discipline. Consistency and patience is what you need to do. So now actually let's get into some data, right? When can you actually go out and start saving? When does your commitments actually come in, right? You have a finite period to save for whatever goals that you have set, right? When you're somewhere between 22 27, that times your savings are a lot more, right? But you look at your consumption is also going up. So anybody in their 30s would know that yes, it's India is currently at an inflection point because we are heading into $3,000 per capita GDP. Anybody within their 30s are at that inflection point. Anybody who's at their 30s would know that going forward, there are many things that are to be lined up. There's kids' education that can come in. I might have a house goal, right? So there will be more and more contributions that come up, and you're starting to earn more, right? So anytime there is a case of this is the life cycle, right? So up until 40, you are great. After 40 is when you have to think of, okay, now I need to think of retirement and how much corpus I need for me to go out and start to retire. How much is enough? Now we've done multiple Instagram lives. We have done multiple क्या बोलते हैं उसको, Twitter spaces to show that yes, how much is enough, to have that conversation with you, to say that how much is enough. Right. In fact, yesterday also we had that Instagram live to understand how much is actually enough for you. So what's enough for you might not be enough for somebody else. Right. So The cycle is this, right? Where after 30s is where you get a very good period of 10 to 15 years where you can actually make sure that what you save actually takes care of your retirement life after 50. Right. Let's look at it. How do you plan for your finances, right? How do you write your own story in retirement? Now, this is the most important. Everybody thinks that 1 crore means only saving in mutual funds or buying direct stocks. It's not the case at all. The most important thing for you is to insure yourself, right? We already covered managing your loans well. That's where the commitment part actually come in. So uh, you must make sure to fulfill all of your commitments. Like say, for example, if you have a home loan, if you're able to pay it off within 7.5, 8 years, that's fantastic, right? So that is one part. But insurance is one extremely important part. Term insurance and health insurance is extremely important for you and your family. That being tax efficient, that is all coming in separately. But the most important thing right here is one is to insure yourself. Your insurance is actually your helmet, your elbow pad, your knee pad, basically protects you from everything that can come. And it's unknown, right? You need some level of protection. That's your first line of defense. Once your first line of defense is extremely strong, and once you're insured properly, only then you should actually look to start saving and diversify your savings. That is what we talk about going into mutual funds. That is what we talk about going into PMSs. But the first thing majorly is to insure yourself. That's the most important thing, and have adequate amount of insurance. If you don't know whether you're adequately insured, just send us a hi at the end of this webinar, and the insurance team will get in touch with you and make sure that you are insured adequately. Right? We do get in questions to say that I am already having a corporate insurance. My company is taking care of it. What do I do? Is it enough? No, it's not enough. After you quit or once you lose your job, that becomes redundant. That's nothing that you have to work with. So you have to always have something on top of it. To give you one example, for me, the corporate insurance that came actually helped the family group insurance, family insurance. It actually helped during a very tough time that I had a couple of months ago. On top of that, I already had some bit of insurance for my family, and it helped me. Right? It actually did a good bit of. It made me calm in those scenarios. Otherwise, I would have had to think of multiple other things. And my family was very good. They were not tensed up at that point of time. So that insurance actually helped me on top of my corporate insurance. Right. So once your first line of defense is met, diversify your savings. That's when you can actually go out and start making money, make money for you. Right. This managing your loan comes separate. If it might take some time, yeah, to fulfill your commitments. That's your actual potential, and it's not like we have ready money, we are aspirational, you own a house. There is always a home loan that you can go and take. One thing that I would say is your personal consumption loan should be reduced off, right? Unless and until you have the ability to pay it off, within that particular year or within a couple of months, don't take it, right? That just adds on to you and puts a strain on your savings kitty, right? That's what I would say. All right. These are few things. If you do right, it will actually pay off for you. So where are people's money actually right now parked? Right, the majority of you would have in real estate. And the problem with real estate is that today the rental yields are not very high. It's somewhere around 2.5, 3%. And it's not liquid, right? Unless and until you have a house in which you're staying in, then there's no problem. But if you're looking to do only real estate investments, be aware that this is not liquid in nature, and the growth that you saw in the last 20 years, you might not see that level of growth that can come in terms of rentabilities and in terms of property price appreciation, right? That's one, right? Then these are three baskets where investors are actually overweight on, right, with their savings. Second is being too conservative by having only fixed income. This way, you are not going to beat inflation. Beating inflation is very important. Today, inflation is somewhere around 4.5 to 6%, but your nominal household inflation is somewhere between 10 and 12%, which means your FD is not covering up. Right? If you think that I have my money that's growing, if your money is growing somewhere between 7.5 8%, you're not growing very well, and then it's not even tax efficient. Your tax comes in, you're not making much of money, right? So it's not going to beat inflation in the long run. So you need to have a mix of equity, fixed income, depending on the cycle, right? Then there are investors who are only doing equity. Doing only equity, there is a bias because investors think that only if I do this, I'll make more money. I need a 20%, 25% CAGR. And if you notice in the last 2 years, the majority of the money has only gone towards small and mid caps, right? Where valuations have gone up extremely higher than their larger peers, which again is not sustainable, right? So you do take a bit of volatility, you do take a bit of cyclicality when it comes to investing in equity. So our approach is that we have always had a multi-asset sort of approach. Wherever there is opportunity is where you should park your money. You should not be picky when it comes to parking your money just into one particular asset class unless and until it makes sense. If it does not make sense for you, then you should have a multi-asset sort of an approach because it's open-ended. Then you can take advantage of whatever scenario comes your way. Now, the most important thing is once your insurance is covered, how do you go out and diversify your sort of savings? Right, they're extra. The main thing that you know is sort of a mismatch when it comes to how assets sort of work is that investors think that they can use debt as high return for debt to sort of expect equity returns to come from debt, the equity returns itself to give more like private equity return, right? So what is each asset actually meant for and how much of it you should have in terms of your allocation, right? See, cash and cash equivalent, it should be in safe avenues, right? The thing is, you should not think that it should beat inflation or something. It's just meant for contingency and emergency, right? Contingency and emergency, like I said, we are getting this opportunity now for arbitrage. So you should take that advantage. If you want to take that advantage, anyway, the number is going to be there at the end of it. Just send us a hi. So how much of it you should have? You should have about 6 months of expenses that you're able to sort of save in just pure liquid. It's not meant for high growth at all, right? Then there is gold and silver. Yes, a lot of investors in India do have physical gold, physical silver. So it is a hedge. It is treated as an alternate currency. Anyway, it is going to get, there is always going to be a use case for this. Treat it as an alternate currency. Don't treat it as growth. Treat it as alternate currency. In the last 4 years, gold as an asset class has delivered somewhere between 14%, 13.5% CAGR, which is extremely good. So for equity, which is delivering you 14.5 or 14% sort of CAGR in the last 5 years, has not done a very good job because gold and silver, again, is an alternate currency where it is much more, the risk level that's there in this precious metal is far more lower than equity. Right, so your percentage allocation should be about 5 to 10% of your net worth, right? Then fixed deposit, treat it only as capital preservation for regular income that is coming to you. This may not beat inflation in the long term, but our endeavor is to not go overweight, is to have some portion that is coming to you as regular income. That can be somewhere between 20-25% of your net worth, right? Real estate. Now we've put real estate to be emotional security. Now, I understand that, yes, I think for everybody here, buying a house, living in your own house is, of course, a metric that shows that you're financially stable and that you're financially secure, right? Thing is that it is extremely capital intensive. You're going to be fulfilling those commitments for a very long period of time that can eat into your savings potential. Right. So anybody who's having an overweight onto real estate, make sure that you diversify into other asset classes, make the other asset classes into more liquid category, that is more equity oriented, that is going to be more liquid debt sort of oriented, where you're able to make higher returns that are liquid in nature. So that should not be more than 40 to 60% of your net worth, right? Equity, again, it's risky, it's volatile. Depending on your risk score is what you should look for. one major thing that it is not suitable for short-term goals. Understand this, that you cannot have a short-term goal and say, I'm going to invest in equity. That's not going to work for you at all, right? You need a long-term horizon. You need the cycle to play out, and it depends on when you enter also in the cycle. If you entered somewhere here, then understand that there will be a genuine time correction, a long time correction that can come to you, where you're caught up on the wrong part of the cycle, right? So that should not be more than up to 80% of your net worth. Right. Now let's actually go into, once you diversify your saving. You saw that savings habit and investing habit. Now, how much SIP are you currently doing? Let's delve into how fast you can reach that 1 crore and what you need to do to reach that sort of 1 crore. Right. So how much SIP are you doing? Let's take a poll. So do put in your answers in the comment box. How much SIP are you doing? It's a good mix of B and C, and B and C happens to be somewhere between 10 and 50,000. So yeah, we can take a midpoint 25, 30,000 is what you're currently doing as SIP. Now, let's say you do that sort of SIP for now we'll take that 25, right? In how long can you actually reach a crore? So in the first out of 10 years, what you save goes to X, assuming minimum rates of 12%. Though it's you should be expecting somewhere between 9 and 12. That's what the Indian market has sort of grown at over a very long period of time. That is 30 years. Anywhere between 9 and 12%, you should assume that yes, that's a good rate for me to grow at. Uh, let's say if you're able to grow at 12%, your compounded annual growth. So you reach a crore probably in 10 years, right? All math is going to show you that you're going to probably reach in 10 years, right? Because your first double is going to be your 2x wealth is going to come in the first 10 years. And then after that, you have a significant jump, right? In 20 years, you have a significant jump. So anybody between 30 by 50, if you just stick to doing 25,000 more as monthly SIP or 50,000 odd, you're going to get somewhere between 2.5 to 5 crore, right? It's so simple, right? Of course, after that, it depends on how much you're wanting to take out of that 5 crore, because you're not going to take out the whole thing, right? So still you will have a good amount of growth that is going to come to you while you get a monthly sort of an SWP out that is going to service whatever commitments you have, whatever expenses that you have on a monthly basis, right? So this small 25,000, what you're currently doing, is going to work for you in the next 20 years. Now, you don't know how things are going to look like, whether you need to time it. You don't need to time it. You just need to be consistent. Here, it doesn't show. It's all public data, right? It's just from DSP. So whatever data is there here on all the presentations is all public data only, right? This doesn't show anywhere as to where you have to invest. This only shows how you're just going to be consistent in saving, right? And they just assume a high or a mid end somewhere between 12% is math. But if you be consistent, you can actually sort of go out and achieve it much more faster, because you're going to be stepping up your sort of SIP. Now, when was the last time you did a step up of your SIP? 6 months once, 10%. Okay, very good. Yeah. No other replies. We've had one that is last year, one that is 6 months, may 10% in 6 months. Okay, last year, which is 12 months. Yearly about 10 to 12%, but I do weekly SIP. Okay. Actually, there's a very interesting point on doing a monthly SIP or a weekly SIP. Okay. Which I have not covered anywhere. But I think there is a good data point from White Oak because they publish that data on their presentations. Uh, when should an investor should an investor do weekly? Is the returns better there? Should an investor do monthly? Is the returns there? So I will not tell you the answer, but I do hope that you actually spend some time to go and look at that data. Very interesting data. Not what you will expect, but very interesting data. Somebody has committed more than 4 years. So there is something due from your side. You have to step up SIP now. So a lot of you have gone out and said last year, right? So again, let's say if you just step up your SIP by 25%, 25% is a large number, by the way, because 10 and 12% is gettable. 25% again happens to be a large number, right? So, uh, assuming you do a yearly, this is 10,000 rupees. We've taken 10,000 rupees and you do a step up SIP. Again, you are able to, and assuming sort of 12%, you are able to reach that 1 crore number somewhere 1 year or 2 years faster than what you can, right? What usually you can do within 13 years or so for your for your sort of first crore, uh, you are able to do 1 2 years uh, faster, right? Approximately is 6 months, 7 months, but I'm telling you 1 year. But 6 to 7 months is what is that particular number that as you keep on contributing more, that time period sort of goes off. Now you look at this, right? This is the other data. It's all public data only. 10 years is what it shows. If you do a 30,000 and you have a 10%, which is what most of you are doing, you have a 10% annual increase, you can reach it in 10 years, right? Where we had that math of 2.5 years extra. It's actually somewhere between, that's what I was somewhere right? 10 years is what it would take for you to reach that particular 1 crore target. Now, there's no poll, but I want to ask you this question. Right? Do you think that 10 years is a long period of time? I prefer a lump sum during erratic times like elections are day, but it's very rare and difficult to time this. We are very rare. And the thing is, what we have faced this time is that time nahi deta. It doesn't give a lot of time for you to take that advantage. And on that day, we had so many issues regarding for transactions on that day. It was an industry specific problem that we were facing. So yeah, you can get a lump sum. So what we do for Milestones as a behavior is we get you prepared always. You will always receive a message from us saying that it's a very good time for you to do a lump sum now. Otherwise, we just stick to you doing SI, right? But even if you do that sort of lump sum, it does take off some amount and some time for you to reach that 1 crore. Right? Somebody has commented saying 10 years for me is not okay. I don't want to be okay with doing this in 10 years. I don't need, it's too long. So what you should be doing is you should be doing more. Strive to do more. Right? Uh, it will take you some time for you to reach that 1 crore target because only if you contribute more is when you will be able to reach that particular target, right? As you keep doing more, right? Let's say you go more and more up, you start doing 50,000. And if you see you're able to reach a 3 years or 2 years faster than if you do more again. So everything is to do more. And if you're going on a particular treadmill, if you're going on a particular plan, right, have that assumption that yes, it would take me somewhere between 8 and 10 years to reach my first crore, right? Now, next question. 1 crore हो गया, I have met the first crore. How long will it take for me to reach my other crore? One is done. Two, look at this. Might take you 8 years to reach your 1 crore, but the next crore is going to take you 4 years, and the next crore after is going to take you 2 years, and the next crore after is going to take you 2 years, right? So by 18, right, you are already see the first journey is always tough. Your first journey is always going to be slightly tougher because only if you show that sort of persistence, you show that sort of consistency, and you show that sort of discipline, then it starts getting easier and easier for you because compounding is working very fast then. This is not even assuming that you're stepping up. If you're just doing 70,000 and you're growing somewhere between 11 and 12 also, 11 and 13 also, right? It will take you somewhere between 8 years to reach your first crore. Now, this is a very, very powerful slide because what investors and savers are usually in that assumption is that the 10 years is too long. What they don't see is that you have a 20-year horizon. Anybody in their 30 has a 20-year horizon to save, right? And to make sure that your savings are making money for you. The first 10 is going to be your first crore, or your first 8 is going to be your first crore. But after that, right, it's going to straight away take you to 5 crores or 5.5 crores, right? So by the time you reach, you can add, you're adding 1 crore almost every year. That is what investors sort of miss out on. That when we are setting this particular target, it's actually for you a 5 crore target. It's not a 1 crore target. But the first 1 crore, I'm very happy that you said no, it's not this 10 crores is, well, sorry, this 1 crore to reach. Is it a long period of time? Yes, it's a long period of time. Somebody said no, it's not a long period of time, but most of you do say when their interactions are that yes, it takes a long period of time to reach that first crore, and it's a big task. Yes, but that big task in the next 10 years after that helps you almost add a crore every year. So by the time you are in your 20th year, you're finished, you're almost done with 5-6 crores. Your 1 crore has actually become 5-6 crore because of your discipline, because of your consistency, and because of your patience. Right. So your journey to 1 crore should begin today. Your journey to 1 crore is not hard to achieve, because what we are striving to achieve is not 1 crore for you. It's more on the 5 to 6 crore side, right? That actually should be your journey. And that's what we want your journey to sort of be. And we are not assuming very high rates also at somewhere between 12%. All of this is public data, right? So now I think you should have a good look at this behavior model, because we had some good comments that said I will do a lump sum whenever uh, there is some sort of volatility. Yes, in a boring market, what Milestones2Wealth as a behavior model, what we do is a mix of lump sum, SIP, and step ups. So in a boring market, we get very excited. That's when we like to participate a lot more. That's where your participation should be a lot more. And in exciting markets, we sort of reap the benefits. Now, reap the benefits only happens in two parts. One is extreme optimism. Like extreme optimism. Things can never look good from here. Sorry, things are extreme. Nothing can go wrong. Nothing can go bad from here. That is one. Second, only if your goals are met, that's when you should actually reap the benefits of an exciting market. Otherwise, you should look for a boring market elsewhere. Right? Today, boring market is in debt, arbitrage, and precious metals. So you should look towards that part as exciting market in equity. Right. So look to always take advantage of the boring scenario. Wealth creation is boring, but however, it reaps the benefit for you. You will actually start seeing benefits only coming in for you after the 10th year. Right. So we love boring markets, and what we do as a behavior model in Milestones2Wealth is a mix of lump sum, SIP, and step ups, and exciting markets where you'll actually go out and start reaping those benefits. right? So now I'll open the floor for Q&A. I'll put in the number here. So whatever query you have that I'm not able to meet, I will redirect you to the center number, and then from there you will be redirected to a team that will take care of all your queries. So whatever questions you have, please put it in the chat box. If you want me to go through a particular slide that requires more that requires more of my efforts, please do let me know, and I will probably do that. Last slide, okay? This one or this one? Your journey to 1 crore or the behavior model? I think it's this one, so you must have a good look at this. It's all public, huh? It's nothing that we've calculated. Everything is public. Uh, do you have a guide in asset allocation, please? Please share with me. See, the thing is, there is no guide to asset allocation, right? You are made to believe that you must do, this much percentage in equity, this much percentage in debt, this much percentage in gold, but that's not the case, right? It should be flexible, and it depends on that particular market condition, and it depends on your particular goal and your risk appetite. Now, if you are an investor where your ability to take risk and your willingness to take risk both are not in hand, and you're actually a sort of a conservative investor, once we take the risk test, then in specific conditions, your allocation to somebody who's aggressive, their allocation will be completely different, right? So it's not one size fit all. It has to be tailor made. Your asset allocation has to be tailor made only for you, right? This is where we come in to help you understand first what sort of an investor you are. Are you financially fit, right? Is your first line of defense covered? If it's not covered, then we first have to redirect that to that. Then we start building it into, then you need we start planning for asset allocation. So it is not a one size fit all. It has to be tailor made only for you. There is no basic rule. The only basic rule is that it has to be tailor made for you. And depending on your risk appetite is what your asset allocation should be. See, the thing is, if the investors get sort of narrow minded because they're only seeing equity, right? But you need to, when you're building wealth, you need to be holistic when it comes to building wealth. You have to see your entire asset and liability base, where your how much money for you is there in real estate, how much is your total allocation towards debt, how much is your total allocation towards equity. Everything you have to sit and see. So that's why we have financial planning team that does that particular job for you, helps you, keeps you aware, and gives you a sense of direction. Once you get that sort of direction is when you can actually work towards asset allocation. But it's not one size fit all. It has to be tailor made only for you. Is there a minimum amount which you fix for lump sum? No. Whatever you can do, you should do. There's no इसने ज़्यादा किया, he'll get more, I did less. You should do what you can do. It's your wealth creation journey. It's not his or her. It's yours. So what you can do from your side, you should do. Short brief about I thought services. Gopi, can you just put our website? Can you put the link? I'll just put the link, in the comment box, and you can see the whole team. You can see their qualification, and you can see what all services that we offer. Hold on, I'll just tell him. Yeah, you can just go to ithought.co.in. You'll get it. So it's a new website also. Just developed that. It's just made much more better now. Just launched yesterday, the new website. So you can have a good look at it. So all brokerages are warning that the market is at all-time high. We should book profit as some promoters are also selling stake. What do you do for retail investors? Retail investors, like I said, in a boring market. Always look for a boring market. There are opportunities on the debt side. There are opportunities on the precious metal side, arbitrage side. So why don't you just redirect whatever you were saving into expensive asset classes to cheaper asset classes? This has nothing to do with going in and going out. That's not how you must have a holistic wealth creation journey, right? So redirect your savings towards asset classes that are cheap. Today, all brokerages are telling one thing, tomorrow they will tell another thing, day after they will tell another thing. So what you must be doing is redirecting your savings towards cheaper asset classes. Hi, we understand the power of compounding is based on the charts and graphs. If you do, but without it, practically there are a lot of uncertainties. For example, a person loses a job. See, this is where we come in. You cannot do this by yourself because you will always need handholding. And Milestones to Wealth is more handsy than what your mutual fund distributor or your platform can do. Right? There are teams that are working for you day in, day out. There are portfolio reviews that my team does. Second, there are reviews that take place for your plan. Right? So you must always work with a financial advisor, even if it's not us. Right? For example, if a person loses a job during recession, what does that mean? You cannot say invest. What do you do? Yeah, that at that point of time, the entire thing has to change. Then again, we have to go back to the drawing board to see what is the target. Do we have to change the target? Right? How do we manage that particular target? Some years for equity might be very bad. Likewise, some years for you also might be very bad. Right? So you must always work with an advisor because of that. Right? When there is some change in the scenario that happens, you cannot take a call for yourself. You need some sort of professional who can decide, say, yes, you must take this sort of direction. When that in your health, you're having some bit of habits that is not healthy for you, and then some unforeseen thing happens where you have to, go to the doctor. After that, the doctor tells you only one thing, but now from here on you have to change. From here on, you take another direction. You don't stop. Doing what you're doing, but you just do it in another direction. Likewise, for that also, in this particular part, you must get in touch and you must work hand in hand with your financial advisor, right? When scenarios change, when situations change, scenarios must change, direction must change, right? Then only you can get this sort of hand in hand to navigate through whatever uncertainties that can come. Any example for that? I've spoken so much about debt, precious metals. I've done majority into. I've done a good amount of webinars for the debt and precious metals as well. So just go on to Milestones2Wealth YouTube, and you will have go to the live section. You will find most of our content. Why initially only with equity mutual funds? Why don't in direct equity? See, it depends on your risk appetite. Direct equity needs some bit of skill. It's not as easy as what it looks. The level of work that goes into direct equity, you're not assigning cost to it, but there are costs to it. A mutual fund is just 1.2% expense ratio or something, 1.3. For that cost, you are getting a well-researched, well-covered basket of companies that you're investing in. There is a fund manager that is continuously reviewing it. It's very well regulated. AMFIs and SEBI both are doing a wonderful job to regulate the whole industry, right? So it's well regulated. You're having enough diversification within that particular product, right? There is a proper research team that goes into understanding what are the risks involved in that particular company. Still, after that, also there are multiple things that they can get wrong. We've seen it in the past, right? So if you say that a team of 10 people can't get 100% right, you're just opening screener and then but seeing one stock, seeing the chart, P, and yeah, I will go and do that. That's not how you should. So that's not how you can be serious, no, on wealth creation. You have to be serious when it comes to you saving money, right? So mutual funds do a fantastic job because they are very well covered, very well researched, that they sort of manage, and it comes at a cheaper cost than it what can come. Don't go for zero brokerage because of course there are hidden charges there. You are still getting very cheap advice. So you must only look at mutual funds. Even for the PMS that we are having, right? We don't treat it as equity portfolio. We treat it like how mutual funds are treating them, right? Because here we are building wealth. So you have to have that sort of an approach here, right? So why initially any equity mutual funds? I think you should own mutual funds, whether be it debt or be it precious metals or be it equity. You should first look to the mutual funds. That first 10 years can give you enough experience for you to understand how things work. And after that, then you can look at more complex products. Today, first thing is you want to go towards a complex product. That is not the right approach. Thank you. Thanks. Debt and precious metals will need to study opportunities. And I've done multiple webinars on precious metals. I've covered very easy, simple stuff only. I don't like to keep things that are complicated. Very easy, right? So just go through that particular webinar. Duration is what we have covered from a knowledge series point of view. So you can get some bit of good knowledge on duration and precious metals. Mutual fund inflows at an all-time high, especially small market. Do you think small and mid caps can be treated seriously, or it's in the reap benefit stage? It's in the exciting stage, and it's in the very exciting stage. And you're right. I think you've done a very good job of tracking and making yourself up to date with what the inflows are. So kudos to you. Very good job. And it's in the very exciting category. There are multiple very exciting categories within the entire market. What Milestones2Wealth always looks for is boring. And Shamsa has done multiple boring videos. Thing is, it gets our endeavor was to show that yeah, you can do a lot of boring stuff also. Boring stuff is what gives you consistency, discipline for you to build wealth, and you can still build wealth by taking much lesser risk than what the market is doing. So stand out of the market. Don't follow the herd. Stand out of the market, and always look for boring. I'm not active in social media. It would be great if we receive WhatsApp updates via message. So we are already doing WhatsApp messages. Always you will get on. I don't know if you're on the platform, but please get onto the platform. Just send us a hi here. I think after you've come onto this, you'll automatically come into our system, and we always send WhatsApp messages via via the API, the central number, and you will get messages from our side regarding events, opportunities to invest in the market, what you can do, and that is only going to get better because our plan is that now that a lot of investors have come onto the program, messages that are tailor-made for you. So that's why we make you do the financial health checkup. That's why we make you take the risk profile test. That's why we do a lot of activity so that we can tailor make solutions for. Why do we need to invest in regular instead of direct? For the same mutual fund, always it shows regular direct. Does it differ in terms of sector? No, it doesn't differ. No, there's no change. It's just the expense. Regular, so we are also doing regular only. Regular is basically through channels, through mutual fund distributors. So the cost to distribute, you distribute products, right? Even if you go, if you see our biscuit, everybody gets some sort of distribution commission. So regular funds do distribution, and that's why you see little expense ratios high. But what I would say is that don't get too picky about expense ratio, because as and when mutual fund AUM starts going up, there was a revision also in expense ratios. As the mutual fund AUM starts going up, expense ratios will start coming down. It doesn't matter. The expense ratio is already captured in the NAV on a daily basis. So it's not 12% minus 2%. No, it's already covered in the NAV, right? Regular, direct, both are same. It's just the channel in which they're distributing. Direct is on their website. You can do direct on your own through platforms, whatever you want to do. Regular is through a distribution channel. That's why that extra cost comes in, and the distributor gets some bit of commission. There's a comment. Hi, hi. If you do have any questions, please do put in the comment box. By the way, next month we are going to have a vernacular series we are trying for the first time. So we will have the same content. We will try to add a little bit more slides to Journey to 1 Crore. It is a Journey to 1 Crore series, and it's a vernacular presentation. So from the team, my colleague Archana would join in, and she would take over the Tamil channels and the Tamil communication. I will try my best to sort of support her in Tamil. And then in the course of the month, we will have a Hindi alone Journey to 1 Crore presentation. So from here on also, you will see a lot of vernacular uh, content that comes out from our side. I will majorly be on English and Hindi. So you would see me there, and I will be supporting on the Tamil channel. May I know what your special studies is financial background is? So I have done my PGP in portfolio management from National Institute of Securities Management. It is a SEBI's arm alone. You're commenting fantastic. I know my struggle. I'll leave the floor open for another couple of minutes and then uh, adding whatever questions you have, please do put in the chat box. Is it tough? See, if you know with any higher education that comes in, like building wealth, this again is an asset. And in this asset also, you must show a good amount of commitment. You must show a good amount of discipline. Some amount in coin app in MF, what to do better to shift or continue? See, I would always say get professional advice, right? I've covered this entire hour saying that you must first think of your insurance, all your, let's say, get aware with where your assets are, and once your insurance is done, what sort of direction you need to take. For all of this, right? It's a very complex activity, and you need hand holding. You need the right guidance. So just purely sticking to platforms or purely sticking to uh, such things might not be very fruitful for you in the long term, right? If you just keep taking medicine without going to the doctor, you don't know if you're taking the right medicine, one, and you don't know how that medicine is going to affect you, right? And I've had first-hand experience seeing this. So you don't know how things, but that's why you must always look for professional advice. I would say first get a professional advice, then talk about whether you want to shift or not. What if it makes sense? What if what you're doing is right? Right. So first, always get the financial health checkup. Just send us a hi. We'll send you the link. Get financially fit. Get aware of where you have to be financially fit and how you can be financially fit. We are also having a 401k webinar in the evening at 7:30 today. So if you have friends, family, colleagues who are residing in US and Canada, please do tell them also to join that particular webinar. Uh, it is available, so the invite is available online. You can just go to Milestones2Wealth, you can just go to iThought on any of our Twitter handles, our Instagram handles, and you will get the details right there, right? Or even on YouTube, right? But it's purely for 401k. We are also reviewing investors who are in the US and Canada regarding their savings. So we are building expertise even on that side. Recently started with interview, is you will see the benefits of how Milestones2Wealth is, taking place for you. When we do SIP, you're unable to continue after a few years due to uncertainty, kept on hold. Again, you need to resume. Possible to do it without any penalty. There's no penalty, no. If you've stopped it deliberately, then there will not be penalty. If you had some where you not where it got rejected, then you would have penalty at that point. You can resume it. You should resume it. And I don't think that we are having any more further questions. But if you're not on the program, do get out of the program. Just send us a hi with whatever query you have, whatever you require some solution for. Please do send us a hi, and our team will get in touch with you. I'm looking forward to see you again next month. Thank you so much for your time. Have a great weekend ahead. Let's hope India wins something today. Thank you.